Hello, world changers, stock market wizards, and aspiring millionaires. Welcome back to Investing Lighthouse. Are you prepared to embark on a profound exploration of the vast realm of investment knowledge? If so, buckle up because we're traveling back in time to dissect a classic One Up on Wall Street by the legendary investor Peter Lynch. And don't worry, you don't need a DeLorean for this trip. First, let's set the stage. Who is Peter Lynch? And why should we care about what he says? Well, Lynch is an investment superstar. Imagine LeBron James in the financial world. He ran the Magellan Fund at Fidelity Investments from 1977 to 1990, posting an annual average return of 29.2%. By the time he retired, he had turned a modest fund of $18 million into a behemoth of over $14 billion. If that's not enough to make you sit up and take notice, I don't know what will. Lynch's investing philosophy is as simple as an apple pie, yet as profound as the universe. He strongly advocates the concept of investing in areas within your expertise. He doesn't possess a crystal ball or has remote access to the Federal Reserve's plans. No. Lynch's investing philosophy is simple. Observe, analyze, and capitalize on opportunities hidden in plain sight. His strategy, common sense paired with rigorous research, like Sherlock Holmes, minus the Victorian attire. Now, on to today's topic, Lynch's renowned book, One Up on Wall Street. The title is not just a catchy phrase to reel you in, folks. It's a statement, a philosophy, and a challenge. Lynch firmly believes that everyday investors, like you and me, can outsmart the Wall Street bigwigs. He argues that our daily experiences give us insights that Wall Street analysts, with their fancy charts and reports, overlook. So pay attention next time you're at the mall, as your next big investment idea might be hanging on the clearance rack. You can find winning stocks at the mall, at work, and even at the dinner table. It's like finding a treasure in your backyard. Let's get this time machine rolling. Now, let's uncover the 7 golden nuggets of wisdom from Lynch's One Up on Wall Street. Each of these points could be a game changer for your investment journey. So hold on to your seats. Invest in what you know is probably Lynch's most famous mantra. And no, he doesn't mean to invest in pizza just because you love it. Lynch encourages investors to invest in industries they understand and companies they believe in. It's about leveraging your knowledge. Are you a tech enthusiast who understands the latest trends? Then tech companies might be your golden goose. Or perhaps you're a fashionista who knows what's hot and what's not. Fashion retail could be your playground. For example, Lynch invested in Hanes when he noticed his wife bringing home their pantyhose. Who said shopping doesn't pay off? Fundamentals. The tedious yet crucial aspect of investing. Look at the factors like earnings growth, profit margins, and debt levels. It's like checking a car's engine before buying, not just admiring the shiny exterior. It's like choosing a sturdy minivan over a flashy but unreliable sports car. Lynch would rather invest in a boring company with robust fundamentals than a glamorous one with shaky finances. Lynch favors companies with specific business models. He also recommends sticking to companies with straightforward business models. Have you ever heard of Starbucks? They sell coffee, and you buy coffee. Boom. Simple. If explaining the business feels like decoding the Da Vinci Code, it's probably not the best investment. Be patient. Lynch says, the real key to making money in stocks is not to get scared of them. Patience extends beyond being a mere virtue. It is a strategic investing approach. Keep in mind the old age saying that Rome wasn't built overnight. And similarly, crafting a prosperous portfolio requires patience and time. Lynch reminds us that stocks aren't lottery tickets. They are shares in actual businesses. And businesses take time to grow. We're here to plant seeds and watch them grow into mighty oak trees. So, leave day trading to adrenaline junkies. Lynch strongly advocates long-term investing. While the stock market is like a hyperactive child, always jumping around. But as Lynch puts it, you get recessions. You have stock market declines. If you don't understand what will happen, you're not ready. You won't do well in the markets. Remember, folks, patience is an investor's best friend. Avoid hot stocks. Yes, you heard that right. Lynch steers clear of the hot stocks, which everyone and their dog discuss. Think of it like trying to get the latest sold-out sneakers. You're likely paying a sky-high price by the time you're in. So, while everyone was busy chasing the dot-com bubble, Lynch was probably eyeing dull but solid companies. So, avoid following the herd. Blaze your trail. Diversification, the magic word in the investment world. It's like having a balanced diet. It is advisable to avoid the risk of concentrating all your investments in a single entity. However, finding or striking a balance and not having an overwhelming number of investments that become difficult to monitor effectively is of equal significance. According to Lynch, the crucial aspect is to achieve diversification while maintaining a level where you can effectively manage and monitor your investments. So, it's about finding that sweet spot between risk and control. Small businesses are like tadpoles. They have the potential to become frogs. Lynch believes in investing in smaller companies with room to grow into industry titans and become potential 10-baggers for your portfolio. These companies tend to be in unpopular industries, have a unique and scalable business model, and have a solid management team. They also usually have a niche product or service, show consistent earnings growth, and plenty of room to grow. For example, Netflix was once a tiny DVD by mail service. Early investors who saw its potential are now laughing all the way to the bank. Or think of Amazon. It was once a little online bookseller. Investors who held on through ups and downs are now basking in the glow of phenomenal returns. So, hang in there and remember that investing is not a sprint, it's a marathon. Finally, Lynch advises us to ignore those scary market predictions. You know, the ones proclaiming doom and gloom every other day. Yes, markets have ups and downs, like a roller coaster ride. But as Lynch points out, more fortunes are lost by people preparing for market corrections or trying to anticipate corrections than by the actual modifications themselves. So unless you have a functioning crystal ball, focus on the fundamentals, not the prophecies. So, there you have it, folks. One Up on Wall Street is like an investing masterclass in a book. It's got humor, insights, and a whole lot of wisdom. In the grand scheme of things, Lynch's principles remind us that investing isn't rocket science. It's about understanding businesses, being patient, and most importantly, learning from our everyday experiences. So grab your investing cap, do your homework, and get ready to one-up Wall Street. We're eager to hear about what you think. Do you see your world through the Lynch lens? Are you ready to spot opportunities lurking in your daily life? Share your thoughts in the comments below. Remember to hit that like button, subscribe, and turn on notifications for more financial wizardry. See you in the following video, investors. Let's keep leveling up, one investment at a time.